Hey everyone, welcome to the weekly sort of macro overview from the macro shop. So I'm recording this on the afternoon of Sunday, February the 1st, 2026. So as I like to normally do, let's first of all just look at sort of the big picture, see what's on the calendar. Obviously, we have quite a few earnings coming up this week, but just in terms of macro stuff, quite a few central bank decisions. Some of them are quite interesting. The RBA interest rate decision on Monday, so that's tomorrow night. Now we know the RBA, is a little bit concerned about sticky inflation. We just saw that housing prices seem to be sort of appreciating still in the major cities in Australia. So it's going to be interesting to see the not expected necessarily to hike, but just the forward guidance from the Australian government. New Zealand jobs, I guess, okay. But we do have the refunding announcement. So the quarterly refunding announcement. Obviously, we had the nomination of Kevin Walsh and his views on the balance sheet. Will there be something sort of interesting from the Treasury coming up on Tuesday, the quarterly refunding announcement for the bond market? Then, of course, for US, we get some employment data. It's a big week for employment data in the US. So we have the JOLTS number on Tuesday, then the weekly ADP, maybe not so important, but we do have the ISM services, and the employment component is always key. And then, of course, the big one is going to be, apart from Canada jobs, we get the US non-farm payrolls coming up on Friday. So a lot of employment data this week, and that should, in some sense, clarify some forward paths of what the Fed may or may not do. Apart from that, we also, as you can see here in the red, we get some big central bank decisions. The ECB following the Bank of England, but the ECB is going to be interesting just because the consensus for quite a long time, the last 2 or 3 months, was that the ECB was in, quote, a good place and didn't need to either hike or didn't need to cut. But the recent run-up of the euro had some governors at the the board of governors, the governing council on the ECB, saying in the last week or so that the strength of the euro could be a little bit deflationary because imported goods would be a lower cost and therefore domestically inflationary, and in some sense that maybe the ECB needed to start a cutting cycle, or at least cut once or twice. But of course, on Friday, we got a bit of a blowout in the US dollar in terms of upside strength. So let's keep an eye on that. And also, just finally, something which is quite big, you see Amazon earnings and Google, so some of these big earnings, of course, on Tuesday, Wednesday afternoon. But we do also get, an important thing in Japan, apart from the auction here. You see here over the weekend, we had the Japanese election. And of course, just with what happened in silver and gold and everything on Friday, it got lost a little bit. But of course, in the Japanese election, the idea is that the incumbent Prime Minister, Takaichi, if she gets a bigger majority for her Liberal Democrat Party, could that weaken the yen on the idea of a bit of fiscal dominance, too much fiscal spending, too much stimulus, too much issuance of bonds? We'll see, but we'll talk about that later on in the week. Okay, so let's just get back and look at a few charts and see what's going on. First of all, I want to look at volatility overall as a sort of a complex, the volatility complex. And I think really what we got on Friday, there was quite a few big moves, potentially triggered by the announcement at about 6:50 a.m. on Friday morning that Kevin Walsh was the nominated person for the next Fed chair by President Trump. But what we did get is just in general quite high volatility. So you can see the VIX here got up almost to 1920 over the last couple of days. It came down a little bit in the afternoon, but quite elevated levels. The volatility of the VIX itself is a little bit higher than it's been for quite a long time. And then if you look at something like, obviously, in the precious metal space, extremely high volatility in gold, and obviously in our friend silver, extremely high vol, even if it came off the highest levels. In oil as well, relatively high vol in oil. So the point is that in commodities and the equities, relatively high vol. I don't have it here, but also in the currencies, the volatility is definitely picking up. If we look over at bonds, not too bad. We see that the MOVE index is off its lows, but still relatively contained. So that's kind of a good thing. In a sense, but overall volatility is picking up. And just one general point about that is that obviously we had big sell-offs in sort of gold, but especially silver last Friday, and in some sense quite a lot of volatility in the equities. But it's going to be interesting to see if tomorrow on Monday, most institutions, actually let me rephrase that, all institutions have VAR, volatility at risk sort of measurements, which essentially as volatility rises across the complex, generally risk manage will force traders and those holding positions to deleverage a little bit to reduce size. So the point is that we cannot necessarily assume that everything was blown out and everything was kind of flushed out of the system on Friday. Probably that's true for a lot of the precious metals positions, but it could just be with the general sort of ramping up in volatility across, all asset classes. There could be some further scope for just a trimming of size across a lot of assets. And who knows, maybe just in order to achieve that, in order to cover some positions, maybe the losses in the gold and silver complex, there may have to be some deleveraging or reduction in sizes in some, healthy assets just to sort of rebalance the books. So the point I'm trying to make is that tomorrow, Monday, could be quite interesting. And let's not assume that everything has passed, because there could just be some mechanical reduction in position sizing just because of the volatility and some of the losses in the precious metal space. So let's keep an eye on that, especially in the first 2-3 hours of trading tomorrow. Okay, so what I generally like to do as well, let's just look at some of the ratios, because on this Sunday video, I do like to step back and just look at some of the bigger picture. And again, a lot of the consensus trades were sort of blown out of the water a little bit yesterday. And when I say consensus trades, think just like the rotation trades. Let's have a look at those. Obviously the precious metals, the weak US dollar was consensus, very strong capex for AI was consensus, and the hyperscalers, is that all sort of okay? And then of course emerging markets versus, let's say, the US, and let's say the developed markets against the US as well. So let's just look at some of these ratios quickly. So before we actually look at the individual, sort of prices, let's just look and see, for example, like the Mag 7s, let's see how they go. So they had a bit of a down day on sort of Thursday, but generally nothing too bad on Friday. So, you can't really draw any inferences there. If you look at the equal weights, again, down, but it came back flat. So nothing particularly crazy there. And if we look just over at some of the ratios now, I just want to have a look at an overview. So if we look at in terms of the US stock market versus government bonds, again, nothing too crazy. You could say that overall the equities are down a little bit, so we're just hovering around the top there, but nothing to write home about at the moment. If we look within the equity space, and this could be kind of interesting here, let's start looking at some of them. So if, let's say, we look at the QQQs versus the TLT, which is a 30-year bond, essentially, again, you see that the equities overall down a little bit. If we look at, let's say, the small caps versus the bonds, you can see the small caps down quite a lot. So we're starting to see some underperformance there in the small caps. What is interesting is the tips in the gold. And I don't know if I mentioned that last week, but I was looking at that and just thinking, how crazy this was. That, remember, that tips which are inflation protected and actually are in theory a good thing, in gold, which yields nothing, absolutely being destroyed against gold. But we saw a big reversal on Thursday and Friday. So tips having a bit of a comeback against gold. And we know that gold sold off against a lot of things, but this is going to be an interesting one to watch, whether the inflation protected, the TIPS ETF continues to, make a bit of a comeback against gold, which, as we know, is technically sort of an inflation hedge, but it doesn't pay anything. So it's interesting. Now, other things to be looking at is going to be the continuing run up in the semiconductors versus the general market SPY here. Again, that's sold off. So the broader market outperforming the semiconductors. And then we say, well, okay, what about there's just a couple of other ones we want to have a look out here. Let's just look now globally as well. Let's have a look at a couple of others. So here we've got the SPY versus developed markets. And again, SPY, which had been underperforming, so the US is coming back a little bit. What about against emerging markets? You can see that the SPY had been underperforming emerging markets and again came back a little bit. And what about SPY versus emerging markets excluding China? Same thing. So what we are kind of seeing here is just in general that overall, we can say the US broadly made a bit of a comeback against other developed markets. The US made a bit of a comeback against emerging markets. We can see that the broader index outperformed the small caps and some of the tech stocks and whatnot. Now, if we look at some other ratios here, let's see what we've got here. We've got some. I just want to look and see where is. We'll look at those a little bit later. Okay, so that's kind of interesting to be looking at all of those. So let's now go and look at some of the specific markets. Now, obviously, why don't we start with the precious metals, because there's been a lot of talk about those. Now, just a couple of contexts. Okay, we all know. Let's look at gold, for example. Okay, gold had a big sell-off. Interesting. Again, so where I want to put this into perspective is, first of all, that does the uptrend remain in play? Now, it depends how you look at it, because what I've got here, I've got these moving averages, but these are not my normal or standard moving averages, which are 20, 50, 100, and 200-day moving averages. These are much, much longer term moving averages, which a lot of CTAs or trend following institutions follow. So the point I'm trying to make here is that for a lot of sort of institutions which have a longer term time frame, one could argue that the uptrend has just been scratched a little bit. So the fastest EMA is now causing some deleveraging and some reduction in position sizing. Absolutely, I'm not denying that. But you could argue that from this longer term perspective, we would actually have to see more of a breakdown. Now, if you actually then look at the technicals, you can say, well, okay, I do like the Fibonacci's, and you can see here that gold, just from even this this perspective here, anchoring it from the 2nd of January. So from this year, you can see that gold technically is still up this year. Okay, so we had that big sell-off. Obviously, it was a blow-off top. We all know it was overbought on the stochastics and the Bollinger Bands and the RSI. Every man and his grandmother knows that. So what's interesting now is what happens. We can see here that we're now at the 61.8 fib retracement, or a little bit below, just into the 65% fib retracement, the so-called fib pocket, and that was bought. So the macro still seems to be in place for me, and this is going to be interesting to see what happens as we go through the week. Similar kind of situation here. We can see that in the gold and silver ratio, which had been at a historical very, very low level. Obviously, sort of gold making a big comeback here against the against silver. So we'll just keep an eye on that. But again, let's look at the one which lost a huge amount, which was silver. Now, this did do some technical damage, even on a very long-term EMAs, which I have here in the blue. You can see see gold just got to this level, whereas silver got down to the 2nd level here. So that's a deep sort of retrenchment. If I actually just go back to the more classical EMAs, so not the CTA, commodity trading advisors, 32, 128, 64, and 256 EMAs, but we go back to the classical 250, 100, and 200, you can see the damage here is a lot nastier. So we've got below the 50-day sort of EMA. We've also blown through, let's just get rid of, let's have a look at the fibs here, and we can start looking at some fib retracements, and you can see here that something like this, you can see here that we've actually blown right through the fib retracement. So that is definitely a nasty sell-off, and that's going to reduce position sizing and whatnot. But as you can see here, it is still, if we look at the beginning of January, we're basically at the beginning of the year levels here. We've blown through the 50-day, but it was bought at this sort of, sort of horizontal support side. So what's going to be interesting here is to see what the bulls do with this, because the uptrend is still in place, and I would argue that the macro factors are arguably still in place. So the first thing which I'm going to look for at silver is just to see what the bulls could do with this, because if we just do it like a basic fib retracement from this recent high on the 29th of January, you can see here that what the bulls will need to do, they have a lot of work to do. The first hurdle for the bulls, I always like to put hurdles and sort of goals. They need to get up to this 38% fib retracement, which, as you can see, is an area of congestion and quite high volume. That's at around the $92, let's call it about $92 level. So at this point, they've done about half of that work, but the technically is still failing there. We need to see them get through there, and they need to chunk through. They need to force their way through all of these levels at the 50% fib, which is about $98, over the 100. And we can't really say that the precious metals bulls are back in charge on the silver charge until they get above the 61.8, which is about $103. They're not there yet. Anything less than that is just a reactive bounce. So at this point, plenty of work absolutely for the bulls to do. But having said that, what is interesting, if we look at stochastics and we look at things like the RSI, what is interesting for the bulls and those who believe in the debasement trade is that both for gold and for silver, which we're looking at here, you can see that the RSI overbought has been substantially reset. So that's a positive. And the point I'm trying to make here is that if you look at this little retracement we had just after Christmas, the RSI measure was reset, and then we had another bull run. And if you also look back in late October, the RSI was reset. So what is interesting is that, let's say, for example, we get a 2 or 3 or 4 day sideways consolidation here. Maybe the market doesn't fall too much more and it just sideways consolidate. What's going to happen is that RSI is going to go into I'm not going to say an oversold level, but it's going to sort of consolidate nicely down maybe into the the 30s and 40s. And could that reset everything for another bull run. It's possible. So let's keep an eye on all of that. But for sure, a lot of the weak hands have been blown out. And what's going to be interesting is I'll talk about it a bit more. But if we looked at the commitment of traders on Friday afternoon, and we can see that even going up to last Tuesday, the number of institutional longs was actually quite small. The institutions had been getting out quite a lot of time. And if we can assume, as I said at the top of this video, that because of the high volatility, there's going to be a lot of resetting of risk limits. The point I'm trying to make is that it's going to be fairly clean in a few days if the silver and gold market just kind of fiddles around and sort of does a sideways consolidation. And that could actually, in my humble opinion, reset the potentialities for another bull run. But not just yet. Now, similar kind of situation in copper here. You see again on the copper chart, you can see the RSI is being reset into a lower level. We reached some kind of a fib sort of extensions were achieved and blew off, and we're now just back down. But again, if we just have a look at some of these EMAs, you can see here that even in copper, a little bit of technical damage, but it's still a relatively bullish chart. I mean, we had a bit of a blow off top. Okay, everything's reset, but we're still just above the 20-day EMA. We haven't even breached the 50-day EMA. So the point I'm trying to make is that in the precious and the industrial metals, was that a nasty price action blow off top? For sure. But, if we do get some sideways action, it could reset for another bull run. Of course, if the bulls cannot consolidate and we just continue to see some nasty bleeding, that could then reset it, and and for sure we could get further long liquidation. Let's keep an eye on that. Just while we're in this section here, which was where I kept my Bitcoin, and again, there's been some talk about Kevin Walsh's sort of position on BTC. We get it. We understand that his father-in-law is very close to Trump. We understand that he's part of the inner circle. He married a Lauder heiress. His family wealth through his wife, of course, not his personal wealth, but through his wife, Lauder Cosmetics, is apparently about $2 billion. He's part of the inner circle. Is he crypto friendly? It seems that he's relatively crypto friendly and is certainly not against crypto. So I'm not going to go into all of that. But what is interesting is just the technical situation here on the crypto, at least on the BTC. I won't talk about Ether or Solana or anything like that, but just on the BTC chart here, you see that we have had the price action has been heavy. I've been saying that for quite a few days here. And we did have, finally what was essentially weak price action. One could argue that was a sort of a grinding lower sort of bear flag. And look at these EMAs. The 20 EMA is still pointing downwards. Even the slower EMA, are all sort of trading in a heavy fashion. However, having said that, I would say that the conditions are ripe here for some kind of bounce, even if it's a technical bounce. I mean, you've got, okay, so what are the key levels? One could argue that we've got this whole zone here about 72,000. If you look down here, you also obviously have all of this stuff going back to about 9 months ago in April, about 75. So, if we look at the Fibonacci extensions here, which I'll just clean this up a little bit, you can see that some of these measured moves, as I like to call them, so you see here the boom, 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 these measured moves are getting a little overdone. We're now into sort of horizontal support around about 75,000. And the 1.618 measured move is, we're not quite there. I mean, what we could do is put on the, what is the other one? The 1. Hold on, let's have a look. What's the other one? The 1.2. Oh, I should know this. It's about 1.2. What is it? 2. Oh, I can't remember exactly the fib number. But the point is here that we're getting close to that. Don't quote me on that number because that's not the exact Fibonacci extension between 1 and 1.618, but it's something like 1.217, something like that. But the point I'm trying to make here is that we've also reached that level. So therefore, I'm just going to get rid of that. I should actually put that more permanently on my charts. So the thing is that I think BTC could have a reactive bounce, absolutely. But if I just clean this up a little bit, again, similar kind of situation. We have to say, well, what do the bulls need to do? Like the true believers, the evangelicals, what do they need to do? They need to do a couple of things. So if we put it on the shorter term one, we can see that at a minimum, in order just not to be a sort of a technical bounce, we need to see the very first order of business would be for the BTC bulls to get up to the 38% fib retrace at about 81,000, 81,500 minimum. But really, they'd have to get above, let's say, 85,000 to have any kind of, sort of bullish price action. And then, to be honest, on a longer term perspective, if we just redraw the fib, you could argue that the 38% level is which coincides nicely with some of these levels, is at about 84,000. So at this point, let's see if there's some kind of reactive bounce, but they're really the levels you should be anchoring the fib from, let's say, the 28th of January, and then maybe a second fib anchoring from the 14th of January. And the minimum you want to see is a 38 or a 50 or a 61.8% fib retracement. If it gets above those levels, one could argue that there's some kind of, potential for a bull run happening. But until then, until and unless we get to those levels, this price action is still trading very, very heavily. Let's just leave it at that. Okay, so moving on to some other markets here. I want to also just talk about the dollar and where we're at with that. So again, this is one of these very consensus trades, the debasement trade, lack of Fed independence, Trump and the Treasury. There was some talk about rate checking and all that kind of stuff, which was interesting. We did get Treasury Secretary Bessent, as I said, on Friday. I think he came out, or was it on Thursday or even Friday morning, saying, no, we're not trying to weaken the US dollar versus, the Japanese yen. Okay, so pretty obviously what we got is a big bounce over the last couple of days, especially on Friday, and some people are attributing that to Kevin Walsh. Is that possible? What I would say is that there's a lot of people short, so we could get some short covering here. And of course, it was a horizontal support. And again, purely from a technical point of view, if we throw this dollar index onto a 4-hour chart, which is just a little more detailed, for a little more, to use that horrible expression, granular, let's just look at this. So I'm going to put it on. Let's have a look, maybe just back here. So let's have a look and see what's going on here. So the bulls are now at a pretty interesting pace here. You can see that on the 4-hour chart, the moving averages are starting to point outwards, although the slower EMAs are still pointing downwards. But it is interesting, and one could argue a bit of a key point here for the dollar index from a technical perspective. We have resistance here at about the 97 level, which also is a 38% fib retracement. But so far, so good for the bulls, for the dollar index bulls. But again, this is going to be key if we go maybe the Sunday night open tonight and then going into the trading session tomorrow. They need to get above here. But if they can get above, it looks like a pretty critical level is going to be the 97.3. If they can push above there, we could get a further push upwards. And if we just go back onto the dollar index here, that could actually, you can see here, again, those key levels are a little bit higher up, but so far looking quite good. And again, that's going to be a similar kind of technical issue for the other currencies, obviously in the negative. So we see here the euro basically sort of falling off. We see even the Swiss franc here under a little bit of pressure because that was very sort of over sold the US dollar. So without going into all the details, US dollar having a push up against all the currencies. So look on the individual charts. But again, I recommend looking at some of these sort of Fibonacci levels. And again, what could also be interesting, I want to look at the Aussie dollar because as I mentioned, tomorrow night, Monday night, our time, we do have the Reserve Bank of Australia. Now, if we just, I'm just going to clean up the charts here a little bit. But again, we're back to that quite key level, which has, a very, very key horizontal level at about 69 cents. You see it broke out, and I've circled that. So now we're back there. And if we look at the fib, let's just put that on the pocket here. You can see here that we're getting that also coincides with the 38% fib retracement at about 69.32. So probably let's see if that consolidates tomorrow during the North American session, and then it might depend if what the Reserve Bank of Australia does, if there's some if there's a hike, if there's a hold, if it's a hawkish hold, forward commentary, it's going to depend on that, and we could get another sort of rocket ship going higher, or if the market continues to believe that Kevin Walsh represents something important, that could also maybe just get a bit more of a sell-off in the Aussie dollar. We shall see. All will be revealed tomorrow. In terms of some other markets, I want to have a look before I talk about Kevin Walsh and bonds, just at oil. And we can see we had the OPEC Plus meeting just today, Sunday. And pretty simply, they decided, apparently the meeting took 6 minutes. It was decided at OPEC Plus meeting that they didn't want to increase the output. So one could argue at the margins that's a little bit bullish, but that was very much expected. Now, if we look at the oil price, you can see here that the moving averages are pushing higher. Obviously, a pretty key level here on the CL1 contract, similar kind of thing on the Brent at about 65.75. Again, it could not push through. It sold off a little bit now, but it's been a nice rebound. So let's see what happens at the open tonight, 6 p.m. open, slightly lower liquidity, of course, in the overnight session. It will be interesting. I think we could have a bit of a sell-off because over the weekend, we had some slightly, conflicting geopolitical signals. On one hand, Trump kept on saying that he had a lot of ships, the Armada, going towards the Strait of Hormuz, the Gulf states, all that kind of thing, potentially a strike on the Iranians. There was also talk that some Israeli intelligence and some military figures were in Washington discussing strategy. So could there still be a strike upcoming in the next week or two in Iran? Absolutely, because there's also been talk that the Americans, before their strike, they've been moving a lot of anti-aircraft sort of installations just to bolster defense for the Israelis and for sort of allies in the Gulf states, some of these other, UAE, all these kind of countries, the Saudis, et cetera, et cetera. So it could still be that Trump is still bluffing, talking, blah, 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 and that the real strike could happen once the Americans believe that their military capabilities are overwhelming, which could happen in the next 2 seconds, or it could happen in a week or 2 weeks, or not at all. Why not at all? Because Trump also said that, there's been some encouraging signs of talks. And he says, I think the Iranians want a deal. And the Iranian foreign minister was just out with some comments about half an hour ago, so mid-Sunday afternoon, essentially saying that he thinks that a nuclear deal could be possible, et cetera, et cetera. So a lot of stuff swirling around. Strikes are still possible, but it could also be that at the open tonight, the oil market decides that they're at least verbally, there is some kind of de-escalation. The risk premium, which has been priced into the oil market, could be taken out a little bit, and so we could just get a drift back down. But I think there's still a possibility of strikes. So I'm not convinced that we're going to have a massive sell-off. It could just be that the oil markets decides to drift down, $1 or $2, maybe down to 64, 63 bucks, something like that. So again, I don't think this is a market that there's necessarily a huge amount of obvious price action in. Okay, so let's talk about bonds a little bit and what happened. So first of all, we obviously had the nomination of Kevin Warsh to become the next head of the Fed. So just a couple of things, just a couple of interesting charts here before we get on to, because what I want to do is keep in mind that there were some leaks last Thursday on Polymarket and the betting market saying that Kevin Warsh in fact would be the nominee, and that turned out to be the situation. But let's just see. Well, excuse me, I have a runny nose here, but he was the news was put out by Trump on Truth Social at about 6:48, about 6:50 on Friday morning. So what we can see here is if we look at the SOFR, this is all the different SOFR, this is from the Bloomberg chart. If we look at all the different SOFR contracts, now the SOFR contracts, as we know, is the 3-month sort of short-term contracts, which is basically looking at the well, let's just call it the secured overnight financing rate. So it's the short term, very sensitive to what's going on with the Fed. So really the very extreme front end of the curve. And we can see that more or less, if you look at some of these contracts here, you can look at the key up here, but you can see for most of the contracts, they pushed higher. So dovish. So just keep in mind that there was this narrative, oh my God, Kevin Warsh was super sort of hawkish and he's the mega hawk. The bond market, or at least the SOFR market, the initial reaction has been a little dovish, okay? And so the possibility of Fed cuts actually went up a little bit, okay? Because we had other stuff going on. So let's look at that. Hold on, let's go here a little bit. Now, we can also look at the inflation swaps as well. Now, keep in mind, if the market is pricing in that Kevin Warsh actually would cut a little bit more than the market had been pricing in, again, look at the inflation swaps. This is all the different tenors. You can see up here in the top right-hand corner, all the different tenors. But essentially, inflation swaps, so that's what the market is pricing in, for inflation is going up a little bit. So think about the logic here. Kevin Warsh, potentially not a super dove, but at least at the limit would, potentially favor a slightly more dovish Fed, therefore fighting inflation less, therefore inflation swaps go up. And if we actually look at the spread on the inflation swaps, you can see from the 31st, so this is from, basically done yesterday, the screenshot compared to a week before, you can see that the inflation swaps, look at the front tenors here for 1 year, 2 year, 3 year, 4 year, 5 year, but let's say 1, 2, and 3 years for inflation swaps going up quite a bit. So the market is pricing in a slightly more dovish Fed and is pricing in, therefore, slightly higher inflation. Okay. Now, also, I want you guys to look at here, we have the tick chart, so very, very short term for the 2-year yield. And again, what I'm trying to get at here is this whole thing of like, oh my God, the market collapsed because of Kevin Warsh and the debasement trade is over. And that's why silver went down and gold went down. Keep in mind that silver and gold had low liquidity. A lot of funds had stopped buying. The institutions had basically exited the market. This was a crazily overextended market and just, a lot of technical factors. So I'm not going to attribute the huge sell-off in gold and silver to Warsh being the hawk. A little bit, but I think that's a minor factor. Now let's just analyze the 2-year tick chart because it's kind of interesting. So what you can see here, just look here, when we actually got the news from Trump, the official news, and of course the overnight, look what happened to the yield on the 2-year. It was going down. So you see this 4 a.m. overnight, right? This is the betting markets. Everyone's going, oh, it looks like it's happening. Then Trump at 6:50 a.m. on Friday morning says that Kevin Warsh is his nominee. The 2-year yield went down. Now, why did it go up? We had PPI, so the producer price index. We had that which was hotter than expected on Friday morning at around about 8:30 that came out. Well, actually, not around, at 8:30 that came out. So we did get a temporary spike. But what's interesting is that even with the hotter than expected PPI and the higher inflation expectations, you can see that during the course, the rest of Friday, look what happened to the 2-year yield. It kind of kept on going down, going down, going down. So it started off at about 3.56, went down to about 3.52. So down 4 or 5 basis points here. Okay. What is that telling you? That's telling you that the market at the margin, maybe not massively, still believes that, at the end of the day, a Trump appointee will, in some shape or form, be relatively dovish. Not a super dove, not like Stephen Miran, maybe not like Kevin, what's his name, Hassett. But nonetheless, this is someone who's not going to be hiking interest rates. Okay. And you can see here that, again, just looking where the effective Fed funds rate is, which is this blue line here, you can see where that is now. It's very, very similar to where the 2-year is. So the point is there's a cap here on the 2-year. The 2-year yield is not going up anytime soon, in my humble opinion. Okay. So let's just get back to Kevin Warsh. I'm just going to grab some water. And again, these are just a couple of, so I've just done a bit of research here over the weekend, reading a few things, reading a bunch about his background and his comments, and just a couple of things here. Keep in mind, is he going to be able to come in January and cut, 100 or 200 basis points? Probably not. But even Trump himself last night, Saturday night, made a few jokes that he'll have to sue him if he doesn't cut. I think what we can expect out of Kevin Warsh is someone who believes that ultimately the Fed, let's just put it this way, does not need to be super restrictive. So the bar to hiking is going to be very high. But let's keep in mind some of the factors, the constraints on Kevin Warsh. He needs other FOMC voters. Remember, there are 12 voters. He's one. He needs 7 voters. Another 6 people need to agree with him. So it's not that obvious that he can just walk in and say to everyone, oh, by the way, I'm Trump's buddy. We're all going to be cutting 100 basis points today. It's not going to work that way. And in fact, with the recent Supreme Court, sort of quasi support for Lisa Cook and Powell pushing back, who knows? Maybe Powell's going to stay on as a governor. I don't know that he will, but potentially he could. I think that Kevin Warsh will understand. Remember that he worked at the Fed for many, many, many years, that he needs to build consensus. So he needs to get votes. Secondly, he also needs the data to cooperate. What do I mean by that? If he wants to cut and keep Trump happy, he will need to have data which is, relatively acceptable inflation. So not 3 or 4% inflation, but maybe 2.5, 2.7% inflation, and maybe even a softening labor market and even a softening growth. So he'll need the data to give him the cover to be able to cut more aggressively. And thirdly, with all of the politics going on at the moment, even Republicans in the Senate and certainly Democrats and a lot of congressmen and congresswomen, and everyone is looking at Fed independence, and even the High Court or the Supreme Court has become involved because of the Lisa Court case. Point being that there's a lot of institutional attention at the moment on Fed independence, and so I think it's going to be symbolically, politically, very, very difficult, or more difficult than people believe, for Kevin Warsh just to come in and start cutting willy-nilly 25, 50, 100 basis points when he thinks about it. No. So for those 3 factors, I think he's going to be careful. Okay, so let's just think about what he could do and what some of his opinions are. And again, I don't want to go too deep here because already this is getting a bit long, but for those who are interested, keep on listening. Those not, maybe it's a good point to tune out. But what I'm trying to say is that the balance sheet, definitely he is on record as saying that he's not a huge believer in having super big balance sheets. So QE, he believes that QE distorts capital allocation, that QE privileges financial assets, compared to real world assets, and he doesn't like that. He also believes that too much QE, too large balance sheets, blurs the distinction between monetary and fiscal policy. He doesn't really like that. And he also believes that finally it weakens the credibility of the Fed in terms of its inflation fighting, bona fides. So it seems that he's on record of wanting to pull down the balance sheet. Okay. So you say, well, okay, if he wants to pull down the balance sheet, isn't this going to be a nightmare for Trump and Scott Bessent, because that means that the long-term bond yields will go up and et cetera, et cetera. Not necessarily, because for Warsh, he believes that the reducing of the balance sheet will allow the Fed actually to cut interest rates. Now, why could that be? Because he believes that sort of a certain kind of quantitative tightening or a smaller balance sheet, that will do the heavy lifting of slightly tightening financial conditions and reallocating assets. So the point is that he's basically saying, hey, rather than us trying to play too much with the Fed funds rate, why don't we just make the balance sheet like a really important tool to sort of, for the big picture, to anchor everything, anchor the economy. So he's a proponent of really using the balance sheet as the anchoring mechanism to really allocate, assets in the correct way. And if that's the case, then you could have more convexity with the front end. And convexity means that if you really want to sort of stimulate the economy, then it's really going to make a difference. Okay, so that's sort of the paradox there, that he's basically saying, hey, let's potentially tighten the balance sheet, reduce the balance sheet, and that way we can reset everything. And that will allow the Fed funds rate to actually have more sort of power, because the real economy will actually be in a truer state in a certain sense. So the point is, as well, in terms of inflation, he's also on essence, does that mean he hates inflation? He's basically saying, on record, is saying, rather than having a very precise, 2 decimal point inflation target, 1.98, and then sort of over tightening, he's basically saying he's okay with inflation bands within reason, not precise targets. So he's also on record as saying that in the late cycle of the economic cycle where we are now, he also doesn't like to over tighten. He's saying, hey guys, 2.3, 2.6, who cares? Let's relax a little bit. We don't want to over tighten. So that is something which would argue for the fact that he could be in favor of having a less tight Fed funds rate. And keep in mind that Powell himself last Wednesday basically said that Powell believed that the current Fed funds rate was at the upper end of neutral, so slightly restrictive. So it's interesting that Powell and Kevin Warsh seem to be almost talking the same language here, basically saying, hey, we're getting towards the late cycle, inflation's a little high, but the Fed funds rate is sort of at the upper end. We're getting into slightly restrictive territory. Therefore, maybe if we just keep a band in the late cycle, let's be flexible. Maybe we don't want to be overly restrictive as the economy cools down potentially. Now, the other thing where Warsh is, on record is about AI, and this is quite important. He believes that artificial intelligence is not a speculative boom. He believes that, over time, it is quite disinflationary. He says, give it time, and this is going to increase productivity. So it's a very core part of his sort of philosophy or economic analysis that these productivity gains, which we're going to get from AI, is going to be deflationary and will lead actually to higher real wages without nasty inflation. We're not going to get inflation. We're going to get higher productivity, higher real wages, and strong growth. And therefore, this strong growth doesn't necessitate really restrictive policy. We don't need tight policy. Again, what's the chain of logic? AI, more productivity, growth, but AI will be deflationary. So we're going to get real wage rises. So you can actually cut the interest rate, which Trump will like, and we won't have an inflationary spike. In fact, he believes that AI is going to be deflationary over time, not over the next week, but over time. Let's give it a multi-year horizon. So that's a very key part of his intellectual kind of framework. And therefore, if productivity, according to Warsh, is structurally sort of increasing, we're getting higher productivity, growth is not necessarily by default going to cause an inflationary spike. And so therefore, with this strong labor market, it doesn't necessarily, according to Warsh, lead to a wage price spiral. So he's basically saying it's sort of the best of all worlds. And the key, intellectual plank underpinning all of that is productivity growth. Okay, it's kind of like healthy growth, higher real wages, and it's not going to come with nasty inflation. Therefore, we can cut interest rates. And that's kind of what, Trump is saying. It's what Scott Bessent, Treasury Secretary, is saying as well. And he's therefore, if that's the way you look at things, policy doesn't need to be sort of, actively restrictive, which is where the Fed has been, let's say for the last 2 or 3 or 4 years, in the view of people like Trump and Bessent. So that's kind of interesting. So therefore, to sum it all up, not necessarily from Walsh are we going to get like super aggressive, super quick cuts, like 100 basis points, in June or something like that, but definitely the bar to actually hiking is going to be quite high. And I'd suggest, by looking at this chart here, that the Fed funds rate in the 2 years, if anything, the Fed funds rate is going to go below that at this point. It's going to be very difficult for the Fed to be hiking, even if inflation ticks up a little bit. And you know, when and if once we start getting sort of disinflationary impulses, then for sure, I think he's going to be comfortable cutting aggressively. And who knows, maybe leading into the midterms, what we'll get instead of 2 cuts between, let's say, June and November, maybe it'll be more like 3 or even 4. 75 basis points, 80 basis points, 100 basis points, something like that. And by the way, talking about that, his view on tariffs is similar to the Trump administration. Again, Kevin Walsh, is that he believes it's a one-off price level change, and that ultimately this is not going to cause an inflationary spiral. And even sort of what Powell has been saying is that, hey, like it's in the system. Once it goes in the system, it's like a price range, but it's not necessarily inflation. It's the price goes up and certain people adjust, and therefore we can, and essentially, we can disregard it. So that's sort of where Kevin Walsh is. And so overall, what it's saying is that he believes that we could be in a situation where, it's all going to be about productivity and growth, not necessarily with corresponding inflationary pressures, but it should lead to real wage gains in real wages. And so it's a happy Goldilocks situation. And in that scenario, with inflation, maybe not at 2%, but in a band of 2.5, 2.6, 2.7, maybe it's going to be a happy story. And yes, the Fed at that point will be happy to cut, 50, 75, or 100 basis points, maybe in the second half of the year. Now, is that going to be positive for equities? I'd say so. Looks like it. What's going to be interesting is his views on the balance sheet, but we won't go there because we're getting too late. Okay, guys, so I think I'm going to leave it there for this week because I've spoken too long. As I say, let's keep an eye on the central bank stuff. We've got Amazon and some other sort of big earnings coming out. And of course, let's see, Trump tweets, keep an eye on Iran and anything like that. And again, just these consensus trades. Let's see if the bulls come back to sideways consolidations in the precious metal space. Let's see if there's any kind of deleveraging, which seems to be coming out, and we get this whole VAR, so the sort of the value at risk, the volatility risk measurements mean just a bit of a deleveraging. Let's watch the vol and the VIX on Monday morning tomorrow, just to see whether the equities are affected as well. And again, I just want to be looking at this rotation between small caps and the mega caps, between the US stocks and developed markets, between developed markets and EM markets, and just see if the US dollar continues to have its push higher. I'll leave it there, guys. Have a great Sunday afternoon and evening, and I'll be back tomorrow morning with the macro snapshot early tomorrow morning, Monday. Ciao. Take care. Thank you.